and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today is Ben Poole, writer at CTMfile. Welcome, Ben, to this episode of the Open Treasury podcast.
Thanks for having me, Push. Great to be here.
Wonderful. Thank you so very much for taking the time to share your thoughts with us on topics that impact the world of corporate treasury management and beyond. In today's edition, we shall discuss three topics, namely major cyber attack on financial services payments system could lead to global losses of US $3.5 trillion. 75% of US corporates plan to drastically increase use of real-time payments in the next 5 years. And finally, US 10-year Treasury yield tops 5% for the first time since 2007. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Ben, let's begin today's discussion with the first story, which is about major cyber attack on financial services payments system that could lead to global losses of US $3.5 trillion. Insurance and reinsurance marketplace Lloyd's has published a systemic risk scenario that models the global economic impact of a hypothetical but plausible cyber attack on a major financial services payment system, resulting in widespread disruption to businesses worldwide and potential global economic losses of $3.5 trillion. The three countries that experienced the highest 5-year economic loss from this scenario are the US, followed by China and Japan. The recovery time for individual countries or regions depends on the structure of the economy, exposure levels, and resilience. Cyber attacks continue to threaten corporations and governments with year-on-year costs around maintenance, prevention, and response to attacks increasing. Escalating geopolitical conflicts pose greater cybersecurity risks for corporations, even as a variety of increasingly sophisticated, targeted, widespread, and undetected cyber attacks are being perpetrated. Ben, with cyber attacks becoming more frequent and severe, do you think it is time that global financial services payment systems, multinational corporations, their treasury departments and boards get more cyber engaged and view cybersecurity as an always-on company or top priority?
I think that's a great point, Push. It's appropriate we're discussing this in October. Apparently it's Cybersecurity Awareness Month 2023 this month, so it's definitely a good time to be thinking about it. But I think the always-on point that you mentioned is very valid, because you can't afford to be off on this topic, because that's when your defences could easily be overrun. You broke down the top three countries that could bear the brunt of a potential cyber attack on a global payment system, and the US is by far the most exposed from those stats, risking a loss of $1.1 trillion from that overall 3.5, so nearly a third of all losses, and that's a staggering amount of money. And this study ran a variety of scenarios that 3.5 trillion figure was the weighted average across the three levels of severity that they modelled. Global economic loss was reported at $16 trillion in the most extreme scenario they looked at. Now, obviously, they're not saying that's going to happen, but on the upper end, that's a potential that in one scenario you'd have to account for. So I think the report from Lloyd's highlights the interconnected nature of cyber risk really well, and how it can impact areas like supply chain, which is obviously a big importance for corporates and for treasurers, for example. So it makes it a really complex risk to defend against. And speaking about the research, the chairman of Lloyd's, Bruce Carnegie-Brown, noted that it's too substantial a risk for one sector to face alone, and therefore we must continue to share knowledge, expertise, and innovative ideas across government, industry, and he was talking specifically from the insurance market side as well, in order to build resilience against the potential scale of this risk. And for corporates, obviously, we know this is a serious issue. We recently spoke on the podcast about the 4-day reporting rule of a cyber incident that US firms face. And I'd also like to point out a CTMfile article that you wrote last month, Push, which covered the findings from Cervantes' Effective Board Governance of Cybersecurity report. There's a really telling part of that research where the report mentions that boards are concerned about cybersecurity, ranking it as one of their top priorities. But that report also references PwC's annual corporate directors survey from last year, which states that 59% of directors admitted their board is not very effective in understanding the drivers and impacts of cyber risk for their organisation. So that's not a very good combination, huge risk and lack of understanding. So it's clear that it's something for treasurers, but not just treasurers. Everyone in an organisation bears responsibility for ensuring that a corporate entity is as well protected as it can be. So definitely always on, I would suggest, is the best way to be.
Ben, you made some great points, and if I may add my viewpoint, I think criminals are and will consistently probe and exploit the gaps and the weakest links in the financial services, payment systems, and corporate security control framework, so much so that predictions from cybersecurity research firm Cybersecurity Ventures suggest that the cost of cybercrime to business could reach $8.4 trillion annually by 2025. Now, Cybersecurity Ventures has also said that if cybercrime were measured as a country, then it would be the world's third largest economy after the US and China, which sure is a stark warning to governments, payment systems, and organizations worldwide. And with cyber attacks becoming more frequent and severe, I think it's important for corporations and governments, particularly for multinational companies, operating in different parts of the world, to strengthen their cybersecurity resilience and, as you said, governance to mitigate the risk of cyber attacks. In addition, I think it is also a good idea and imperative, in fact, for Treasury departments to have ongoing and specific payment security training like securetreasury.com for organizations and their employees, which is distinct from general cybersecurity training. This will, to my mind, help in preventing and fighting payments fraud and reducing the impact of such losses in a world of instant or real-time payments.
Yeah, I completely agree. I think just it's one of those areas where the cost of doing something very frequently will be much cheaper than the cost of not doing something, where you're putting yourself at risk. So it's so important, I think.
Oh, that's very well said, Ben. Couldn't agree more. From cyber attacks, let's move the conversation to our next topic, which is about corporates in the US planning to drastically increase their use of real-time payments in the next 5 years, according to the 2023 Real-Time Payment Survey by the Association for Financial Professionals, sponsored by the Clearing House. The research department of AFP, or Association for Financial Professionals, surveyed corporate treasury practitioners about their current and planned use of real-time payments. The survey found that over 3/4, or 77% of corporates, expect to receive B2B real-time payments in the next 5 years, while 76% expect to send real-time payments within the same time frame. Ben, you covered this story for CTMfile, and I am aware that you have been following real-time payments. You write about it and have a particularly distinctive perspective on this. What do you think are the key drivers or benefits that will impel US corporates to adopt real-time payments in the near future?
Well, definitely faster payments has been a big topic with the launch of FedNow in the summer, and obviously in the US there's also the RTP network from the Clearing House, which upped its transaction limit to $1 million around 18 months ago. So it's definitely starting to gain traction in the US, which this survey really highlights, I think. It found that 26% of US corporates are paying vendors using real-time payments today. And so that's the biggest current use case, ahead of paying suppliers, which is at 23%. A further 30% say that they'll be using real-time payments for those use cases, both of them, by 2025, so in the near future. And while paying customer refunds is only done in real time by 12% of US corporates today, a further 27% say they'll be doing this by 2025. So perhaps while firms haven't been quick to switch on that functionality, it does show that customer satisfaction is another driver for real-time payments adoption by companies. Another point that jumped out to me from this survey was that half of respondents pointed to the lower cost of transactions as a benefit of using real-time payments, but a whacking great 80% cited payment transparency as a very important feature of instant payments. And for me, that just kind of emphasized how critical the payment data is that you get in a real-time payment along with the transaction itself. And knowing, okay, in the immediate term, I've been paid or my payment has been sent. That's one point. But in the longer term, actually being able to use that wealth of payment data that all corporates will now be collecting and be able to analyze. This could be sales data, it could be outgoing payments data, and basically run scenario analysis on this to start taking some more strategic action based on the payment data that the organization is receiving and generating every day. And that's an area where the Treasurer really has kind of the box seat because they see all this data. So that's a real opportunity to demonstrate the strategic side of the Treasury role. So I think that's something that will be emphasized and enhanced by further adoption of real-time payments.
To add to your incredible analysis, Ben, if I may add my 2 cents, I think as you mentioned, the entry of FedNow into the US real-time payments market will intensify competition with the RTP network. Now, this competition, to my mind, is likely to benefit corporations by making domestic wholesale transactions and cross-border payments faster and more cost-effective, as you alluded to, than ever before. I think will also bolster corporate cash management and harness real-time cash flow visibility. In doing so, corporations will also strengthen ties with their suppliers, as you mentioned rightly so, and customers, further improve efficiency and witness e-payables and real-time payments reshape the US payments ecosystem for greater digital success.
Yeah, I think those are great benefits, and that kind of sums up the potential of it. Obviously, it's kind of up to corporates to take advantage of this and also banks to sort of build on these rails and find interesting solutions that are relevant to corporates. So it's a world of opportunity. And now I think we kind of enter into the world of, okay, well, let's make this practical and what actually works for our organization, what fits with what we're trying to do, and how can we enhance our processes through these instant payment rails.
A world of opportunity. I hope the listeners were listening to your terrific and thought provoking insights when it comes to real time payments. Moving forward to the third news story for today, which is the US 10-year Treasury yield passed a new milestone on Monday, rising above 5% for the first time in 16 years. The yield, regarded by Wall Street as a key gauge of bond market health, jumped 9 basis points to 5.01% in early morning trading, reaching its highest level since July 2007, when the first stirrings of the global financial crisis were being felt. Furthermore, earlier this month, the German 10-year yield climbed above 3% for the first time since 2011, and Japan's 30-year bond yield reached its highest level since 2013. Ben, what is the likely impact of these pushed up yields on treasury departments of multinational corporations?
It certainly was a milestone start to the week, although I believe the 10-year Treasury yields kind of dropped back below the 5% mark following Monday. I think notably after the CEO of Pershing Square, Bill Ackman, disclosed that he had covered his bond short position. On Twitter, Ackman noted that there is too much risk in the world to remain short bonds at current long-term rates. So I think that's kind of picking on the overall trend of the risk and the volatility that we're seeing, which is something for treasurers to pay attention to. There was also coverage of comments from Jim Reed, who's head of global economics and thematic research at Deutsche Bank, who explained that predicting the recent wild bond market swings has become increasingly tough. He commented that while it was very difficult to pinpoint the exact reason curves steepened so much last week, even if you were sympathetic to the move, on Monday he found it even harder to explain the intraday Treasury price action. So, I mean, if him as a well-respected and revered expert of markets is finding it hard to put his finger on what's happening, what hope for the rest of us? I think for treasurers, it's just a chance to act with caution, which I think treasurers are very good at doing. Always be cautious with the first step. There might be opportunities, but understanding the risk that goes with those opportunities is critical. And I think in terms of how the bond prices got to where they were, obviously some of this, of course, goes to the Fed policy. The Fed seems to have settled on higher for longer as its interest rate policy, which goes against some of the earlier market predictions earlier in the year. And as the story on CTMfile noted, lingering concerns over the budget deficit are also at play. So it's tumultuous, I would say, Push. Be cautious, I would suggest.
Do you think this could have an impact on the borrowing costs or the financing cost of corporates, or given that the US still has a national debt worth $33 trillion and the November deadline is coming around the corner vis-a-vis the debt issue? Will that impact either of these issues?
Well, we've certainly seen with the most recent budget deficit crises in this earlier this year and previous years, the impact that has on certain money markets that treasurers are very familiar with using, and the impact it can have on supply and the impact it has on price. And yeah, I think that will be in the back of everyone's mind heading into next month. And it's something that Paul has mentioned on this podcast a lot. Kicking the can down the road isn't working with the budget deficit crisis. So it's hard to see how that cycle of doing that ends, though. You kind of need you need someone to kind of go and bang a few heads together, I think, in Washington to get this sorted, because it's just kind of stuck in this cycle. And until that can be snapped out of, it's at least showing treasurers that, okay, well, these are the months in the year that I need to be aware this could happen again next year, the year after, and kind of figuring out liquidity management around that, fixing the roof while the sun shines, basically, making sure you've got your liquidity, you've got your access, you've got your lines of credit, you've got things available should you need them, not in an emergency at a time where perhaps market pressures mean that liquidity isn't there. So yeah, it's definitely something to just keep paying attention to, because these crises seem to be coming around sooner and sooner each cycle.
So the things to pay attention to: liquidity, access, and lines of credit, among other important things. Great piece of advice there. Finally, Ben, what is your choice for the biggest or most important story of the past week, and why?
Well, I think this week, obviously, we've had the AFP annual conference going on in San Diego, and CTMfile's parent organisation, Strategic Treasurer, has been over there. So I think I'm going to shout out Treasury associations and the conferences and events that they put on, and what treasurers can get out of from being part of their national or local Treasury association. These kind of Treasury events are so helpful in keeping in touch with trends in corporate Treasury. Not only do they tend to have lots of educational sessions, but they're also a great opportunity to meet your peers in Treasury, treasurers that are going through similar things that you might be at the day job. So a really fantastic opportunity to pick their brains and, hear how they may have accomplished something that your firm is about to start work on, and just kind of compare war stories from the Treasury front lines. The networking events at these kinds of conferences can be gold for that. Networking can be a bit daunting for some, but just remember that pretty much everyone else at those drinks or at that dinner, they're also treasurers. So you've already got lots in common. And also, these events, the banks and the Treasury technology companies and other third parties, they attend these conferences en masse. So it's also a good opportunity to catch up with your current providers, but also perhaps scope out whether there's something better out there for you, see demos of new software and things like that. So just see what's new in the market. Yeah, so the calendar might be running out for 2023, but it's never too early to look ahead to 2024 and just kind of search out your nearest Treasury associations and groups and see what you might be able to pencil in the calendar for next year already.
That's a great reminder and a great message, as we come towards the last quarter, or kind of towards the end of last quarter in another 60 days or so, and move on to 2024. For me, Ben, the most important story of the past week has been ICD unveiling its innovative AI-driven investment reporting solution for corporate treasuries at the AFP on Monday earlier this week. Corporate treasury professionals often grapple with the complexity of analyzing the entire investment portfolio. To aid corporate treasury in addressing investment related challenges, I think a groundbreaking solution termed as ICD Portfolio Analytics has been introduced by ICD that analyzes and reports on all the investments across the entire portfolio of treasury practitioners. To know more, our listeners can visit CTMfile.com and read the article as well as watch the web chat about ICD's new AI powered cloud investment reporting solution. ICD Portfolio Analytics comes at a time when counterparty credit risk has been thrust into the spotlight following the banking crisis triggered by the failure of Silicon Valley Bank in March this year. So, keeping in mind the risk concerns of its treasury clients, ICD designed this new cloud investment reporting solution with the ability to assess portfolio risk in multiple dimensions and also delve into granular detail for actionable insights on counterparty exposure, geographic exposure, and more. Well, we've come to the end of this podcast episode. A big nod of gratitude your way, Ben, for your valuable insights and analysis. We would also like to thank our CTM File audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.